On today's hot sheet, I'm discussing the U.S. housing supply shortage, Fannie Mae's February economic report, and the weekly drop in mortgage applications. Today is Wednesday, February 28th, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning. Welcome back to the hot sheet. Let me know which market you're tuning in live from here today. I am in my Naples studio, and let's jump right into. We've got a lot of data to cover. We have a housing supply shortage, which has been really the last few years of the story here in housing, of course, as we all know, and it just seems to be getting worse when you look at the grand picture. Of course, the last few weeks or the first 2 months of this year, I've been optimistic. I said, okay, these incremental improvements that we cover every single Monday on the hot sheet have been positive. They've at least been better than last year. New listing data and total inventory, but still well off of the marks of a 2019 normal market. And certainly if you look at new listing data comparison to today to the '09 through 15 rate, I mean, it's just so different, so underserved on new listing data. So existing home sales not coming to the market, obviously, and we are building more than we have over the last 10 years, but it's not enough to make up for the lack of a decade of building. Here's the number, and this is directly out of the hot sheet show notes. Of course, BAMX members, you know where to find your show notes. Between 2012 and 2023, there were 17.2 million household formations, but only 14.7 million household housing units. Okay. Single and multifamily were started. Okay. So you've got 17.2 million household formations, but only 14.7 between multifamily and single family, which were started. Only 13.4 million during that time frame were completed. 17.2 million household formations. How does a household form? Okay, so a millennial moves out and starts their life with, maybe it's a marriage situation. They go get a house, they get an apartment, they do whatever, right? Where somebody goes and creates a new household. Somebody or two people or however many people go and create that new household, break away from the household that they were in and create a new household. Okay, so this resulted in a gap. Of course, you've got a gap from 17.2 million household formations and only 13.4 million which were completed. This is 2012 to 23. Okay, I mean 22, 23, we started like kind of building again, right? The shortage gap between single family home construction and household formations grew to 7.2 million homes between 2012 and 2023. Now, just recently, a few weeks ago, we went over, I think it was 10 or more different analyst numbers on how short we are. And the average was like, somewhere in the 4 million range. So you hear this high end number of 7.2, but, or I'm sorry, the top end averages between those two was in the 4 million range. The averages was somewhere between maybe around 3 million. Maybe we can dig up those show notes there if somebody's listening in the background and fact check that. But it was somewhere in that range. Now, what Realtor.com is reporting here, including multifamily home construction, it reduces the gap to 2.5 million homes. And I think that's where that average came in out of those 10 sources who are tracking this. Okay. In 2023, 947,200 single family homes were started, 5.8% fewer than in 2022. So even though we're building, it's a little bit less than what we were doing in 2022. We just went through new starts and projected completions. It's going to be strong because there's enough builders that see this opportunity, but it's not, the builders aren't going out there and like, I'm going to overwhelmingly fill this gap. And again, the big headline, and this is something I would probably use in an email newsletter, a headline that goes out, why are you not seeing more homes come on the market, ... Right. Okay. Well, as a consumer, I might want to open that. And I'd want to go copy and paste right from this hot sheet from the show notes here. BAMX members, obviously, you know where to find this. You get 10% off of BAMX if you use code HOT. So many of you are doing just what I'm saying, copying and pasting these stats and putting it into your communication. Between 2012 and 2023, 17.2 million households formed, only 14.7 started, 13.4 completed, resulting in a gap. This is helpful because there's a lot of consumers that believe, well, if I just wait long enough, 2008 is going to happen and there's going to be an abundance of inventory. Why would anybody go? I was just sitting when I was in Orlando a couple nights ago, sitting with one of the biggest he's since retired from the REO world, but one of the biggest REO holders of that time, of that era. We're talking about somebody who is selling hundreds of REOs really by the month, just a dominator in Freddie and Fannie REO accounts. Okay. And I said, are you seeing any signs or indications that the current REO holders, and he never has to work another day in his life because that's how many REOs were out there, right? Foreclosures. Are you seeing signs that that's going to be a business model in the next few years that's even relevant? And right now, there are no signs of that. In Arizona statewide, there are 29 active foreclosure, 29 active for a state that large. That was another REO holder that was sitting with us that mentioned that stat. So for those that are waiting for this 2008, 9, 10, 11, 12, 13 abundance of inventory to hit, those consumers that are just like, well, it's happened before, it'll happen again, educating them on this gap in household formations. There are more millennial formations coming. There are more coming. There's Gen Z coming up, right? But this gap that we haven't met the formations with the supply would hopefully help some consumers, and I think it certainly would. Most consumers are pretty smart. Help consumers understand, okay, maybe waiting's a bad plan. We saw what happened in 23 when prices were supposed to go down. They set record highs. We talked about it yesterday. Okay, let's go a little bit more. We've got some of these charts, obviously, inside of BAMX for you from Realtor.com. Cumulative shortage of new home supply here is broken up from single family and multifamily to just the single family deficit. If you go single family and multifamily, the deficit's not as large as the blue line, which is the single family deficit, which has been on a cliff in the downward trend since 2016, just falling off a cliff since that time frame. This trend of underbuilding relative to household formation carried over to homeowner vacancy rates as well as rental vacancy rates. Look at the homeowner vacancy rates, 0.9%. Okay, when in 2008 to 10, it was like 3%, over 2.5% in those years. We haven't seen it get over 1% since 2019, and it wasn't even over 1.5%. That's been a big downward trend. The rental vacancy rate, it peaked up over 11% after the GFC or during the GFC. Now at 6.6%, has been moving up as of late. Rental vacancy has been moving up as of late. Okay, up to 6.6%. Very, very still normal level. But why has it been moving up? Well, they have more supply than single family. All the building in multifamily apartment housing is contributing to this vacancy rate going up. Who would have thought? You bring in more supply, you reduce appreciation. I just saw a clip. Somebody from Bigger Pockets was talking about this because they really only just want to focus on, how to make money as for investors, which they do a fantastic job, obviously. But when I'm thinking about the housing affordability, I'm thinking about how can more people become homeowners, okay, not necessarily investors. I love investors, and I love it if you're crushing it in investment. But he makes a great point. He's like, everybody's asking how to get find an easier way to get deals, real estate investment deals. He's like, if it's easier, that means inventory is way up. That means rents come down. And that means your likelihood of not making money in your investment goes through the roof. Right. And so the harder it is to get great real estate investment deals, it means the more likely, you got to be better. You got to have sharper tools, and then the likelihood of being able to get a return on those rents. But you keep increasing supply on multifamily, it becomes um, it becomes less likely that you make money in that landscape. Okay, single family versus multifamily housing starts. Share of multifamily housing starts here. So yearly single family housing starts in the red, yearly multifamily housing starts all outpacing single family starts uh, in every single month from 2012 to 2023. So you've got multifamily for builders and developers as a much safer bet than single family. Single family is expensive to build. It creates a higher price point in most of the areas that it's built in. Home builder confidence recovers as mortgage rates fall. So home builder confidence is recovering, of course, but still, this is relatively low, coming in at 44 in January, but bouncing up from the mid to low 30s, which is where we were when the rates hit 8%. You might see home builder confidence tick off in February. We're about to close out February. We'll see where it comes in next month. But granted, where the rates have been the last couple of weeks, you might see that dip down. Home builder confidence, while it's going up, still lowest. This where we're sitting right now and have been, and then the end of 22 with 8% rates. And then obviously during those 3 months when COVID hit, 2020, March, April 2020, those are the three lowest points basically now. When they started increasing rates and COVID since 2012. Okay, so you would think, well, inventory is so low. Well, home builders are still being very cautious with this market. That's one indication that while we're low, so much inventory, builders can't build the product. That's why you see more apartments than you see single family homes. Builders are handcuffed of building the product that actually meets the real demand that's out there in the market. That median, that average price, that affordable price. Formations versus single family housing starts. Yearly household formations, that blue line is above the yearly total starts everywhere except there's a crossover in 2015, 2016. But we're talking 2.5 million gap when you add in those multifamily starts on top of it, which is the bottom gray line. When you add the red and the gray, you're still 2.5 million on the gap, according to realtor.com. All right, there you go. We'll take a look at some of these local areas real quick here. Daytona list price. This is from January 24 to January 2019. Okay. And then, so we're getting a change in median list price and then a change in listings. So Daytona Beach, 48% up on the price, down 12% on listings. San Antonio is up 17% on the price, but they're up 15% on listings since 2019. Interesting there. Palm Bay, Florida, 38%, 39% up on the price, down 15% on actual listings. The Bethlehem, Pennsylvania area, Allentown, up 72% on price, down 69% on listings. Grand Rapids, Michigan, up 49%, 48.7% rather on price, down 57% on listings. Stockton, California, up 41% on price, down 50% on listings. Riverside, San Bernardino, California, up 47% price, down 49% on total listings. Providence, up 44% price, down 70% on listings. Bakersfield, up 56, down 42 on listings. Miami, up 45%, down 36% on listings. Big correlation there, huh? Don't have the listings, don't have the inventory, price keeps going up. That's why that line from the hot sheet show notes is so important to get in front of your database that thinks waiting more in an inventory starved environment is going to bring prices down because rates are so high. No, it's going to continue to exacerbate the problem we've had for 18 months, which is the lock-in. It's going to continue to push prices up in this spring market, not down. And waiting will cost you more money in all likelihood. All right. So there's your update on the U.S. housing supply gap, which continues to develop in a negative way. A lot of reasons for that. All right. Fannie Mae put out their HPI, a lot of HPI lately. Fannie Mae's February 2024 economic report, housing price index, anticipates modest increase in home sales, so total sales, alongside a downward drift in mortgage rates. Okay. Hey, Fannie Mae, give us the good news. I like that Fannie Mae, but typically, they'll be ahead of some of these other reports. Like when we looked at Case-Shiller yesterday, we're still talking about December and we're about to enter March here. But here's some punchlines here from Fannie Mae. Expect a modest recovery in home sales throughout the year. Total sales, more opportunities for agents and investors alike. Anticipate a decrease in the 30-year fixed rate mortgage to Fannie Mae saying, not me, 5.9% by year end 2024. I love it. Forecast total home sales to rise by 5% to 5 million units in 2024. 5 million units is total home sales. Okay. So we're talking about 1 million on new starts. So 4 million on existing. We want to get existing up to 5 million, but 5 million total. So just to be clear on that, 'cause sometimes people hear 5 million, they're just thinking that existing number that we focus on so much, existing home sales. And we're talking about total on Fannie Mae's list here, not existing. All right, let's dive into the report a little bit further here. Total housing starts, they've got here quarter one, 1.435. This is total housing starts, which would include single and multi. 1.433, 1.417, 1.402. So they have housing starts going down quarter over quarter in 24. And then going up quarter over quarter in 25. That's on total housing starts. So Fannie Mae saying, hey, down year on starts. Single family, they've got every level being above last year. Okay. Every level just over 1 million. And gradually increasing into 25 on single family starts there. So multifamily going down over the next couple of years makes sense. It's been overbuilt to some degree on multifamily, and certainly in some markets, not others, but some. Total home sales, obviously we got as low as 4.48 million on total in quarter four from Fannie Mae's perspective, but they've got us bouncing off of that number. And in quarter three, for the first time on the seasonally adjusted basis, getting up to 5.1 million. And continuing to go up on total home sales every quarter. So 4.7 million this quarter, which would be the most since quarter two of 23. 4.9 million annually adjusted total home sales in quarter two, then 5.1, then 5.2. And then in 25, it goes to 5.3, 5.4, 5.5, 5.7. So total transactions, what I like to call flow in the market, movement, people getting out of the lock-in effect, is, sunny days are ahead. Things are getting better in that sense, according to this Fannie Mae housing forecast here in February 2024. Existing home sales, which is the number I like to look at. I mean, this rarely ever, you have to you rarely see this happen when what we saw in the fourth quarter, which was under 4 million existing home sales, 3.8 million existing home sales. That was a bottoming of historic proportions. You typically have a baseline of 4 million existing home sales on a annual adjusted basis. Well, Quarter four, they've got us bouncing back up over 4 million on existing, 4.2 in the second quarter, 4.3 in the third, and 4.465 in the fourth, only to continue to increase. And by the fourth quarter of 2025, they basically have us back to 5 million existing home sales. That would be a really strong 2025 market in terms of movement. Okay, where prices and rates are going to be. I'm assuming, let's look at what their projection for rates for that year. They've got us in 2025 in the fives, 5.8 to 5.7 throughout the year. So not low fives, but just getting into the fives. You see what Fannie Mae believes is going to be that much more movement. These bottom numbers, if you're watching and not listening, is 5.8 in quarter one, 5.7 quarter two, 5.3 or 5.7, 5.7 in quarter three, quarter four, respectively in 25. And just getting to that level, about 5 3/4 on the 30-year fix, Fannie Mae believes that we get up to this 5 million existing home sales mark. So it doesn't take a lot to get a lot of sellers to start unlocking this inventory and making a move and getting more transactions in this market. High fives or anywhere in that 5 3/4 range, consumers are going to start to see as a normal rate, a good rate, solid rate, fine for them to go and make a move. I mean, with us being the only country with the 30-year fixed mortgage as a product and as an option, yeah, I think anywhere in the fives is a pretty good, solid situation. Don't ever expect 2.75 to come back. And if it does, expect inflation to follow. Okay, we've seen that story now and how that plays out. What is playing out here week over week, more on the disappointing news, is that mortgage applications continue to decrease. They decreased in this week's survey, according to Mortgage Banker Association. Mortgage applications decreased 5.6% from 1 week earlier. The weekly application survey for the week ending in February 2023. The market index, a measure of mortgage loan application, went down to 5.6%. Season adjusted basis from 1 week earlier. On an unadjusted basis, the index decreased 3% compared to the previous week. The refinance decreased 7%. And here's the big one that I always look at, which is the seasonally adjusted purchase index decreased 5% from 1 week earlier. So that is new purchases. The unadjusted purchase index decreased 1% compared with the previous week, was 12% lower than the same week a year ago. Last year, we were talking about low levels of demand in comparison to the years before. These are lower levels of demand, and it really has to come down to affordability. So the rates continuing to sit over 7, you'll continue to see mortgage applications drop. We get back down into that mid-6 range or lower 6s, which we saw even in December. We'll see mortgage applications go up. So applications going down at a time of year here in the spring when we typically will see applications going up. This should potentially help inventory go up, which could help stabilize prices. That remains to be seen. Will there be a breaking point in the spring when buyers just say, you know what, I'm going to go out there and apply for a mortgage no matter where these rates are at? We'll be hopeful that they come down for those buyers. That day may not be today as we sit here at 4.3 here on the 10-year. Look at this. What happened here? What did I miss? I missed something. Let's go to the 1 day. I'll get off. I don't know if that's accurate. I'm seeing a 4 or no, that we got down to 3.8 here at one point today on the 10-year. Is that true? Let's take a look. I'm going to go to CNBC because sometimes Wall Street Journal isn't the best. Let's go to 1 day. Oh, look at this. We dropped down to, oh, no, we didn't. Wall Street Journal's wrong. I'm like, did we drop to 3.8? That would have been amazing. No. All right. We're sitting at 4.3, which is where we've been sitting on the 10-year. I don't know what's going on with Wall Street Journal. Sometimes they don't even know what's going on with Wall Street Journal. Let's take a look at where we ended yesterday in the 30-year fix, 7.16. So that was a tick up from 7.13 the day prior. We'll get the weekly reading tomorrow. There you go. That's your hot sheet. That's your 24-hour look back on all things housing. I appreciate you. Thank you so much for tuning in. By the way, we have a new YouTube channel we just launched with BAM for real estate humor. If you're into the humor side, maybe we can link that up below. We have a brand new video, first video ever for that channel going up today. Here on the main channel later today, we will be posting an interview that I did with Sheila Reddy. Sheila is the CEO of Mosaic with a K.io. I look at Sheila as a pioneer in the prop tech space, somebody who everyone in real estate in a couple of years is going to be looking to get an interview with, have a conversation with. She's fascinating. So make sure you are subscribed and hit the notification bell so you don't miss that video when it comes up here on the main channel. Of course, to get the most out of everything we're doing at BAM, use code HOT to get 10% off of BAMX. You get access to all of our show notes from this show each and every single day that we do the show. These show notes are extensive. Here's just today's, and you've got 2 charts in the mortgage application. You have 13 charts in Fannie Mae and 6 charts inside of BAMX just from today's show alone, along with these show notes. Use code HOT to get 10% off of that. All right. Have a great day. Have a great middle of the week here. And we will, of course, see you back here tomorrow, 9:30 in the East, 6:30 in the West. You know the deal in between. Until then, toodaloo.